relatives have to be the beneficiaries. If the relatives are the beneficiaries, then in that situation you can take the argument that since it is ultimately it is going to go to the relatives, so it will be an exempt transaction, it will not be taxable.
Another amendment is that while computing from other sources, if there is any payment made to a resident on which tax was deductible but it is not deducted under 40A IA, then that would also get disallowed while computing from other sources. Presently it is applicable only for business income, but not this provision has been extended for other sources also.
Sorry, excuse me. Just going back to the earlier point.
Yes.
With regard to the trust and relatives.
Yes.
Are you seriously saying that that's a credible argument to say that the trust is comprised of relatives and so it should be treated in the same way as relatives?
You see, trust is what? Trust is just a legal obligation for the beneficiaries. So trustees are holding the trust property in fiduciary capacity. Okay. So the money of the trust would ultimately inure for the benefit of the beneficiaries, and if those beneficiaries are relatives of the settlor, then in a way that money is only going to be received by those relatives. So if there were to be direct payment by the settlor to the beneficiaries without the medium of the trust, then it would be exempt under section 56. It would not be taxed under 56. So I see no reason why the same analogy should not apply, for the simple reason that there is a legal obligation by our trust which has been created, and trustees are then given the power to distribute the trust money amongst the beneficiaries till such time the beneficiaries remain the relatives of the settlor.
And you see, the scheme of the taxation of the trust is that the trust is assessed in the same manner as if it is assessed in the hands of the beneficiary, except in case of a discretionary trust. So if it is not a discretionary trust, you actually look at the beneficiaries who are the beneficiaries, and then the income of the trust is taxed in the same manner as if it would have gone to the beneficiaries.
But it is a separate legal entity.
No, it is not a separate legal entity. The trust is only holding on behalf of the beneficiaries.
In fact, under the Act, the Income Tax Department has the power to make assessment directly on the beneficiaries also. Okay. So it need not tax all the trust in all situations.
So this trust.
No, it cannot
be.
be.
I am saying option is there with the tax department, either to tax the trust or the trustees or the beneficiaries.
Just for my understanding, just personal. So this trust does not have a separate PAN number?
No, it would.
It would.
It would.
That is only assessed, that is only for assessment purposes. They are treated as representative assessee. The scheme of the Act is they are representative assessee, they are representing the beneficiaries. Okay. So in case the beneficiaries are determinative, in that situation it is taxed as if it is in the hands of the beneficiary. So for example, if it is a specific trust and there are 3 beneficiaries and the trust is prescribed that all the 3 are equal beneficiaries, then it is taxed. You have to then see what is the income of those beneficiaries, and then the slab rates are also applied, taking into consideration the income in their hands.
So I think I would now, I'm through with the my
10 lakhs wala, I think the
yes.
taxation of dividend is now for all entities.
Yes, okay. Under section 115 BBDA, any dividend above rupees 10 lakhs suffers tax at the rate of 10% presently in the hands of individuals and HUFs or firms which are resident in India. Now the ambit or scope of this provision has been widened by providing that the taxation would be in the hands of a specified assessee residents in India. However, the specified assessees would not include domestic company, a fund institution mentioned in 1023C, or a trust or institution registered under section 12AA. So again the scope of this 15115 BBDA has been enlarged to include all persons other than these 3 specified herein for levy tax at the rate of 10% on dividends which are more than rupees 10 lakhs. So again the trusts etc. which will get covered within the ambit of 115 BBDA unless it were to be registered under 12A or 1023C.
There was lot of rumors that the inheritance tax is going to come.
Sorry?
Can you tell me the reason why this domestic company has not been included in the specified?
Why it has not been included in the hands of...
There must be some reason. Now,
Yeah, the reason is, I'll tell you, because the.
Domestic
they
company,
suffer
when they will
tax-
distribute, they will be taxed,
They will be-
except with one layer, the set off. Because the domestic company will ultimately distribute in the form of dividend, and at that stage it will be taxed. Again, DDT will be payable, except that one level set off.
One step and clear out that.
Yeah.
14A will still be continued.
No, 14A, in fact, now you can have an argument that it is getting taxed above 10 lakhs.
That is about 10 lakhs on the SSCs other than domestic company. For domestic company, we continue the 14A.
Provident fund and superannuation funds income are in any case not taxable. They are exempt from taxation. So it would, they would not be impacted by this.
Suppose there is a trust has two beneficiaries and it has got dividend income of 20 lakh rupees. So will it be taxable in the rule of CBA? Because if you divide income into two beneficiaries, it will be not more than 10 lakh. If we say the trust is holding property for the beneficiary, so the dividend has to go in equal ratio to the beneficiary. So each beneficiary will get 10 lakh rupees.
Specific trust.
Specific
Example, it's a specific trust. In that situation, it will not be
No,
subject.
it's a specific trust, and also the share of the beneficiary is specified. And it is not subject to a discretion of the trustees as to what amount they can distribute. If this were to be the case,
Then it should not be.
An argument can still be taken. Right.
Correct.
Right.
In fact, if you see the taxation of the trust also, they have defined two types of trust. One is discretionary trust and second is non-discretionary trust. In discretionary trust, it is taxed as the maximum marginal rate, so you don't get any benefits. In case of specific trust, then they have the option either to tax in the hands of the beneficiary or in the hands of the trust itself. Now, if the beneficiaries are, some of the beneficiaries are like for a company there is a beneficiary. In that situation, the portion relatable to the company is taxed at the higher rate. So it is taxed in the same manner it is taxed in the hands of the beneficiary. So in your example, if there are two beneficiaries, one is falling in the 30% slab rate and the other is falling in the 20% slab rate, the income will be bifurcated in the hands of the trust, and the portion relatable to the lower slab assessee will be taxed at 20% and the other will be taxed at 30%. In that situation also it will be bifurcated. If it does not exceed this 10, because that amount belongs to them.
And if one of the beneficiaries is company, that should not apply.
No, in case one of the beneficiaries company, in that situation also, but 10 lakh,
Then the 10 lakh.
10 lakh will not apply.
So that means dividend received by the trust will have to be bifurcated as per the beneficiary status.
Correct.
And then we will apply this one on.
But this is only for specific trust.
Yeah. So,
Actually, the purpose with which this was started in the last budget speech, you see the finance minister speech, he's talked about large individual owners having companies. They are not contributing to the nation, they should have a higher income bracket. So we are taxing. It has now become like another 43B. Over a period of time, you will start with excise duty, now it has gone down to a cooperative society also. So,
yeah,
the purpose of which it started was totally different
right.
as per the last budget speech.
But most of the promoters, what they were doing was they were putting all their individual shareholding in the hands of the trust. So they actually were not holding any of the shares. In fact, people were doing it for the purpose of inheritance tax. So these two amendments which they have done now, 56 and this amendment, actually it makes it more difficult to create a trust.
Friends, we'll have a very short break of 15 minutes. We'll break for tea and then we'll reconvene again. We have a lot of ground to cover. We have transfer pricing, we have capital gains, and we have certain other important provisions also. So which we'll have after the tea break of 15 minutes.
Saying you have to vacate the hall at what time?
Sorry?
Vacate the hall at what time?
Which is considered as a resident of India or resident in India because of POEM guidelines. So our view would be that yes, because under 115 BDA, the exclusion is in relation to domestic company, now not in relation to a foreign company. So it is specified assessees resident in India. Now specified assessee would include a foreign company which is a resident in India. So if because of POEM guidelines it becomes resident in India, these provisions become applicable. Thank you. I would now request my colleague, Mr. Neeraj Jain, to take up the transfer pricing provisions in the finance bill. Neeraj.
Good afternoon, friends. In transfer pricing, there are three important amendments which have been proposed, which would have of far-reaching consequence. Firstly, it is amendment to the domestic transfer pricing regulations. Payments made to persons specified in 48(2) have been done away with the transfer pricing regulations. Then limitation of interest deductions, that's the second significant amendment which has been introduced. And then secondary adjustments. So these three amendments have been proposed in the so far in the Finance Bill 2017, and they all three are of far-reaching implications. So we come to domestic transfer pricing provisions, which were introduced by the Finance Act 2012, and they apply to specified domestic transactions which were defined in section 92BA, and clause 1 of section 92BA covered payments made to persons specified in section 48(2). Now, the Finance Bill 2017 proposes to do away with the application of requirement of domestic transfer pricing regulation to such payments, and therefore any payment which are made to persons specified in section 48(2) would no longer be required to comply with the transfer pricing regulations, and therefore annual compliance, transfer pricing, etc. Would not be required to be done in respect of such transactions. You see, if you claim deduction under section 80IA, then it is a specific, and if there is any transaction with the related entity to which the said section apply, or which are required to satisfy the arm's length test, then the transfer pricing provisions would apply. But if you are not claiming deduction per se in section 80IA, under section 80IA, then I don't think you are required to do the compliance.
In that case, the due date of filing of return is 30th this September.
Then, since you are not claiming the deduction itself, then the due date would, and you are not filing the certificate under in Form 3CB, then in that case your due date would be 30th September only.
I think, Neeraj, but one point, just Sanjay, I'll come back to you. One point that you'll have to consider is that you may not be claiming 80IA deduction in this year because of loss, or you are not. See, now the question is that if subsequently you are to claim deduction under 80IA, then the past losses have to be set off first, right? If that has to be done, then your correct losses need to be computed for this year, for which transfer pricing will become material. So the tax officer can say that, look, your correct income for this year needs to be determined, or correct loss for this year needs to be determined, because that will have an impact in a later year when you seek to claim 80IA. Because those losses will have to be set off unless you fall in that cases that these are prior to the initial assessment year and prior to the 6 years. That will be another controversy. But if it is at part of 10 out of 15 years, or if it is 80IB, then you will have a different situation. So,
also, one issue would be that you may have if you have 80IC or 80IB unit and you don't get this transfer pricing done, so while you may not be claiming the deduction under that section, but there is still a possibility that the transactions between the eligible and non-eligible units are not at arm's length, and it may result in that higher loss is claimed in a non-eligible unit. So, and maybe lesser losses there in the case of eligible unit. So it is always possible, if you don't get a transfer pricing study done, to show a higher loss in a non-eligible unit. So I would think that transfer pricing would require to be done irrespective whether you are claiming deduction under 80IC or not, because there is a transaction between a unit which is entitled to 80IC, for whatever reason it is not claiming, it's a different matter, because you can, in the case of other businesses, non-eligible businesses, always reduce the profit or increase the loss.
Overall profit. But it will affect the carry forward of loss for the ATI unit for a subsequent year.
And actually, due date for the purpose of is extended from September to November in cases where certificate is required to be filed under section 92E. So in case you are not claiming deduction under section 80IA, and then for that reason you are not making the certificate or filing a certificate under section 92E, then the due date does not get extended.
No, but we will have to, I think, get the certificate done, because he can hold you responsible for the non-compliance of the requirement of law. Yes. I think Sanjay.
Yeah, suppose I have a related party transaction.
Sorry, come again.
I have a related party transaction with, say, company B, that is a rental payment or some business auxiliary payment. I don't claim any ADI benefit, but the other company is claiming an ADI benefit. They have to then, they are under the ambit of 92EB, but am I also supposed to comply with the requirements of transfer pricing? Am I have to submit the transfer pricing study and Form C 3CEB?
No, the requirement of complying with domestic transfer pricing regulation would apply to the company who is claiming deduction under section 80IA. So they would have to be complying with the domestic TP requirements. The other group entity, as I understand you are talking about, who is, say, for instance, transacting with that company, and or the eligible undertaking of that company, that would not be, that is not required to comply with domestic transfer pricing.
Thank you. Another small question. Now, can I consider this to be a clarificatory in nature, some sort of an amendment? Because the intention, what I feel, is basically if the two related parties are both paying tax at maximum marginal rate, then 48(2)B should not have been applied. Maybe for that reason it has been brought back. Now, if there is a past litigation going on, can somebody take a plea that it is a clarificatory in nature, this amendment has come in, but it should be applied from a retrospective date?
This is not a clarificatory amendment. This has been made clear in the statute itself, and it applies only to prospectively. In the earlier regime, prior to specified domestic transactions was introduced, transfer pricing legislation was introduced. The onus for demonstrating that the payment made to related parties were excessive or unreasonable used to be on the assessing officer. And with introduction of these domestic transfer pricing regulation, this got shifted to the taxpayer. Now with this amendment, the onus would now shift again back to the assessing officer, and one would be able to, or taxpayer would be able to take all these conventional arguments which used to be taken that to justify these payment on the ground of commercial expediency, benefits accruing from such transactions, and for the fact that the two parties are tax paying parties and the transactions are revenue neutral. All these arguments now can be taken in respect of such payments now. So initial onus would be now on the assessing officer to bring on record the additional evidence, any evidence to support the market value of the payments, in order to make a onerous intervention in terms of section 40 42. This is a welcome amendment, and this would significantly ease the compliance burden on the taxpayer, and this would apply immediately from the current financial year, that is relevant to assessment year 2017-19 onwards. Then second important amendment is on limitation of interest deduction. So OECD in Action Plan 4, BEPS Action Plan 4 has set out the best practices to prevent erosion of tax base by way of excess interest deduction by MNEs. OECD had recommended limitation of interest deduction with reference to a fixed ratio rule, and 10 to 30% of EBITDA was recommended as the fixed ratio for that purpose by the OECD. Now, in line with the recommendation of OECD, the government is seeking to introduce Section 94A, providing for disallowance of excess interest for computing taxable income of the taxpayer. Excess interest has been defined in the finance bill as the amount of total interest paid by the taxpayer which exceeds 30% of EBITDA, or the tax or interest paid to the associated enterprise, whichever is lower. So this excess if excess interest is found like this would be disallowed in terms of Section 94A. Now let's understand this import of the provision by way of an illustration. So in this example, say interest expenditure on the amount borrowed from associated enterprise is 30. Then interest on amount borrowed from third parties is 20. So total interest paid is 50. Then EBITDA in this case is for instance 100. 30% of EBITDA would work out to 30. Then amount of total interest paid being 50. And 30 being the 30% of EBITDA. So excess interest 20 is the excess interest paid over 30% of EBITDA. Then amount paid to associated enterprise is 30. So out of these two, 20 and 30, 20 being lower, the excess interest to the extent which would not be allowed deduction is 20. So in this example, 20 out of the total interest which has been paid to the associated enterprise of 30, 20 gets disallowed. And let's take another example where the company in fact is incurring a loss. So all other figures remain the same, and then EBITDA is a loss of 100. So OECD in the example, in their guideline in the illustration, has said in such situation is taking 0 as the EBITDA, as the 30% of EBITDA. So if we take 0 as 30% of EBITDA, then situation would be like this. So amount of interest paid in excess of 30% of EBITDA would be 50. 50 is the total interest, minus 0 is 50. Then second element would be interest paid to the associated enterprise, which is 30. So in this case, 30, which is the lower of the two, would be disallowed. In other words, the entire interest which is paid to the associated enterprise gets disallowed. So in this, by way of this example, we understand that maximum disallowance which can happen in this by way of this provision is that the entire interest which is paid to the associated enterprise can be disallowed. So in case of a loss, no interest can be possibly be paid to the associated enterprise, otherwise it will be disallowed. Domestic companies who is paying interest to a foreign company.
Associated enterprise.
For foreign associated enterprise.
Associated in certain situations can be an Indian company also. In the definition under 92.
For this purpose, domestic company or permanent establishment of a foreign company who is paying interest to the.
You are the payer. The associated enterprise can even be a domestic company in certain situations.
Yeah, that's fine.
No, that's what he is asking. Is only a foreign company, or it can be in 92B? You are that definition of associated enterprise.
No, it says in so many words who is paying interest to the foreign associated enterprise.
Excuse me, sir.
Yeah.
There is a query in this in the table. In the first scenario, there is a disallowance of 20.
Yeah.
Now there can be a situation where the interest expense is disallowed under two heads. One is 94B, that is 30% of EBITDA, and the balance could be under 92, that is transfer pricing provisions. That the balance 10 in this case is not at arm's length. So whether that would come into picture or this would stop at 30%. That 10 has still to be proved that it is an arm's length.
You see, these are two independent provisions. If there is an international transaction of payment of interest to the associated enterprise, that has to be demonstrated to be at arm's length. That is one set of transfer pricing provision which is there. This is as such not a transfer pricing regulation. Here you are not determining the arm's length price per se of an international transaction. Here it is generally, in common parlance, it is called thin capitalization rule. So there is a ceiling provided for the maximum interest which can be allowed as deduction. So this can work parallelly.
So that would ultimately happen that for a same amount of interest, I can be disallowed under 92 as well as 94.
Then overall.
See, the concept is different, no? Under that 92, you are determining the arm's length price of the interest. And to that extent, the government is holding you are paying excessive interest. And here, they are saying the interest that you paid the higher amount of interest, that will be allowed deduction limited to 30% of EBITDA. Yes.
In that sense, yes.
There can be 3 times, because if the interest is excessive, you will also have to get it back under a secondary adjustment. So here it will be twice, yes.
Yeah,
No, because this restriction in 94A is to be carried forward. It is to be carried forward and allowed to you subsequently.
You see, once there is an international transaction, it has to satisfy the arm's length test under the transfer pricing regulation, meaning thereby that you have to be applying transfer pricing methods to say, to demonstrate that this is undertaken at arm's length price. So if applying that rule or applying a particular method, transfer pricing method, that interest payment for that, for instance, is found to be at not at arm's length price, to that extent there would be a transfer pricing adjustment. Now, the second rule, which is other than the arm's length test, is this thin capitalization rule or limitation of the deduction, interest deduction.
After a certain date or even to the existing debt?
No, it is with reference to the payment. So now, if you pay interest in this year, and when this law is applicable, so then that interest has to be is to satisfy this limitation rule.
Associated enterprise. That's only domestic or a Indian AE, or it also covers foreign AE?
Permanent establishment of a foreign.
No. This is a AE word used in the last line of this subsection 2. No, the subsection 1 is very clearly non-resident. But while computing the 30%, in the last line, it says paid or payable to AEs during the previous year.
It is for the purpose
That's
of
subsection 1.
So
Right,
two
but
states for the purpose of subsection 1. So
it
it is
comes-
only the non-resident lender.
only.
Yeah.
Then, as I said, this rule is applicable to Indian company or a permanent establishment of a foreign company who pays interest in respect of any debt to a non-resident AE. Then, debt issued by a third-party vendor for which associated enterprise has provided explicit or implicit guarantee to such lender, that would also be treated as a foreign debt, qualifying for this provision. So that is to be treated as debt from a non-resident associated enterprise if it is guaranteed by associated enterprise, subject to a guarantee by associated enterprise. This I would feel is this was not really necessary in a sense that it would have even otherwise such debt which is guaranteed by a associated enterprise would be deemed to be an international transaction in terms of section 92(b)(2) itself. So it is deemed to be an international transaction undertaken with the associated enterprise. So even otherwise, it would have been covered within the ken of this provision. Then debt has been defined in a very wide term to include loan, financial instrument, financial lease, financial derivatives, and so on. And the amount disallowed under proposed regulation is now allowed to be carried forward for 8 years, and it would be allowed deduction in subsequent years, subject to satisfaction of the thin capitalization rule in that year. Threshold of interest expenditure of 10 million is provided, exceeding which only the provision, this provision would be triggered. Then provision would not apply to Indian company or a PE of a foreign company engaged in the banking or insurance business. So this is what it is. And now EBITDA, in fact, OECD starts with EBITDA from the taxable income, with reference to the taxable income, not with reference to the book income, and all interest, depreciation, and amortization, etc., are excluded from the taxable income. That's the way OECD describes this EBITDA for the purpose of this section. And tax exempt income are also excluded in terms of OECD for computing EBITDA. But such provisions, similar provisions, are not incorporated in our proposed legislation. So possibly for the purpose of section 94, BA will still compute EBITDA on the basis of book profit. That's the difference or distinction between the OECD computation and the computation that would happen in terms of section 94B.
The total interest cost is, let's say, 100 crores and 30 crores has been capitalized. So that 30 crores will also be included for the purpose of calculating this disallowance, or only the part which is reflecting in profit and loss that will be considered?
You see, you have not claimed deduction to the extent you have you have capitalized the interest. So this is only limiting the deduction of interest.
No, but the total interest.
You see, in the context of section 48(2), there are a series of judgment wherein it is said that if an amount is capitalized and it is not